In a bold move that has reignited speculation across both the private equity and restaurant chain sectors, Apollo Global Management has reportedly made a fresh bid to acquire Papa John's International and take the pizza chain private. According to sources with knowledge of the discussions, the offer stands at $64 per share, valuing Papa John's at roughly $1.6 billion in equity value, a premium to its current market capitalization. This development follows an earlier joint bid by Apollo and Earth Capital Management in June, which proposed a deal in the low 60s per share, valuing Papa John's at about $1.7 billion. That earlier bid triggered a nearly 7.5% rise in Papa John's stock. While none of the parties have publicly confirmed the new $64 bid, the momentum behind the deal has drawn broader interest and scrutiny. Why Papa John's? Papa John's has long been considered as a turnaround candidate. Although it operates more than 6,000 restaurants across about 50 countries, its performance metrics have lagged competitors. In recent quarters, the company has faced margin pressures, declining comparable store sales in North America, and investor skepticism about its growth trajectory. Taking Papa John's private could grant new ownership the flexibility and time to execute changes away from the glare of the public markets. Apollo brings relevant experience to the table. The firm has previously invested in restaurant and fast casual brands, including Qdoba, Chuck E. Cheese, and the parent of Wagamama. Earth Capital, though smaller, includes among its backers Sheikh Mohammed Al Thani of Qatar's royal family and holds a 5% stake in Papa John's already. Its founders have experience in buying and turning around consumer brands. Earth's co-founder previously led the take-private of Bojangles. From Apollo's perspective, Papa John's represents a platform with underexploited upside. A few levers stand out: operational optimization, cost reductions in supply chain, logistics, and overhead. Refranchising, shifting underperforming company-owned units to franchisees. Menu and brand refresh, innovating products and marketing to re-energize the core brand. Digital and data-driven growth. Enhancing loyalty, personalization, and delivery efficiency. If successful, the synergies from these moves could close the performance gap with peers like Domino's and Yum brands. The mechanics of the bid, the reported $64 per share offer, would command a meaningful premium over Papa John's trading levels. The total valuation hinges on whether the bid includes debt assumption. In many leveraged take-private deals, the acquirer takes on or refinances existing liabilities, meaning enterprise value could exceed $2 billion. Because Apollo is a large, diversified investment firm with strong access to capital, it is well positioned to lead or fund such a transaction. Earth's smaller size does raise questions about how much capital it can commit, but its stake and regional connections may aid in financing or structuring. The due diligence process and negotiation of binding terms may take several weeks to months. The board of Papa John's would likely invite multiple rounds of evaluation and perhaps a go-shop period to solicit competing bids. Regulatory scrutiny likely is limited. While Papa John's has international exposure, it does not appear to trigger major antitrust red flags in its core markets. Risks and hurdles. Though the strategic rationale is compelling, several risks could derail the transaction or the post-deal execution. 1. Financing risk. Credit markets remain volatile. If interest rates rise or lenders pull back, deal terms could shift. 2. Franchisee pushback. Papa John's franchisees who control many local decisions may resist changes, particularly if royalty terms or operational controls tighten. 3. Execution and turnaround risk. Operational improvements often confront execution drag. Restructurings may disrupt service or brand consistency. 4. Competing bids or conflicts of interest. Another investor might emerge, triggering a bidding war, or internal shareholders might oppose the terms. 5. Public relations and brand risk. Changes made under private ownership, store closures, menu cuts, labor restructuring, may provoke negative publicity. The window for a successful turnaround is typically narrow. Extended underperformance or missteps could erode the value of the investment. Market reaction and investor implications. The market's response was swift. On the news of an Apollo Earth bid, Papa John's shares jumped about 7.5% in a single session. Given the new $64 offer, the implied upside is substantial if the deal closes. For existing shareholders, the offer provides liquidity at a premium. For prospective investors, the situation presents an asymmetric bet. Either the deal closes or the turnaround path re-rates the company. Analysts remain divided on whether the bid will go through, whether Apollo and Earth will refine or withdraw it, or whether alternative suitors will enter. For now, the deal remains in flux, with no official confirmation from either Apollo or Papa John's. What to watch over the coming weeks, key indicators to monitor include formal press releases or regulatory filings from Apollo, Papa John's or Earth, whether Papa John's board enters into exclusivity with Apollo, any competing offers or interest from other private equity or strategic buyers, revised debt financing terms or adjustments to pricing, statements from franchisee associations or major franchise owners, operational updates from Papa John's on same-store sales, margins, or restructuring plans. If the deal proceeds on favorable terms and Apollo executes successfully, Papa John's could emerge as a stronger, leaner business. If not, the market may view the loosened offer as an opportunity to press for further change within the public company framework.